All right, welcome. Today, we are diving deep into what might just be the single most important number in all of corporate finance. Seriously, it's a number that can greenlight billion-dollar ideas or stop them dead in their tracks. We are talking about the weighted average cost of capital, or as you'll hear it called, WACC.
So put yourself in the CEO's shoes for a second. Your team walks in with a game-changing but incredibly expensive new project. How in the world do you decide if it's a brilliant move that's going to create massive value or just a catastrophic mistake? That's the kind of high-stakes question leaders and investors face every single day.
While the answer isn't just about gut feel or a coin toss, it all comes down to whether that project can clear a very specific financial benchmark. A minimum threshold it has to leap over to be considered profitable. We call this the hurdle rate, and its formal name, the one we're going to deconstruct today, is the weighted average cost of capital.
So to really nail this down, we're going to tackle it Mises style, breaking it into 5 clear parts. First, we'll define what WACC is and why it's so important. Then, we'll dissect its 2 main ingredients, equity and debt. After that, we'll put it all together in the final calculation. And finally, we'll look at how this all works in the real world.
Okay, let's dive right in. What exactly is this thing, the weighted average cost of capital? Well, at its very core, it's the price a company pays for the money it uses to run its business. It's the cost of being in business, all boiled down to a single percentage.
Think of it like this. A company has 2 main ways to raise cash. On one hand, it can take on debt. Things like bank loans or issuing bonds. On the other hand, it can sell equity, which is just selling off little pieces of ownership in the form of stock. Now, both of those have a cost. WACC simply blends those 2 costs together into one super powerful number. And believe me, this number gets used everywhere. Company managers use it to decide if building a new factory or buying another company makes sense. If the return on that project is higher than the WACC, it's a green light. For investors, a lower WACC is often a great sign. It means the company is healthy, less risky, and can fund its growth on the cheap. And this really gets to the heart of it. WACC isn't just some abstract number from a spreadsheet. It represents the absolute minimum return that all of a company's investors, both the shareholders and the lenders, are demanding for their money. If a project can't beat that rate, the company is actually destroying value by doing it.
All right, let's roll up our sleeves and start deconstructing this formula. We'll begin with the first half of the equation, the cost of equity. This is the return that shareholders expect for taking on the risk of owning a piece of the company.
You see, unlike a loan, equity doesn't come with a neat little interest rate attached, so its cost is a bit more theoretical. It's basically the return the company needs to deliver to keep its shareholders happy. If they don't generate that return, investors will get fed up and sell their stock.
So in the big WACC formula, here's how we handle the equity piece. You take the total market value of the company's equity, which we call E, and you divide it by the company's total value, V. That gives you the weight of equity. Then you just multiply that weight by the cost of equity, or RE. Easy enough, right? But here's the catch. Figuring out that R value is where finance becomes more of an art than a science. The go-to method is something called the Capital Asset Pricing Model, or CAPM. Now, without getting too deep in the weeds, it uses things like how risky the stock is compared to the market to come up with a number. But because it's using the past to predict the future, it's really just a very sophisticated estimate. Okay, so that's the equity side of the house. Let's pivot to the other piece of the puzzle, the cost of debt. Now this, thankfully, is a bit more straightforward.
The cost of debt is pretty much what it sounds like. It's the interest rate the company is paying on its loans and bonds. For a public company, you can usually figure this out by looking at the average yield to maturity on its bonds, which is just the total return an investor would get if they held that bond till the end. It's a much more concrete number than the cost of equity.
So, the formula for the debt part looks pretty similar at first. You take the market value of the debt, D, divided by the total value, V, to get the weight. You multiply that by the cost of debt, RD. But then, there's this critical final piece. You multiply the whole thing by 1 minus the corporate tax rate, TC. And this little part is a huge deal.
And that brings us to a really powerful concept in finance, the tax shield. Here's how it works. The interest a company pays on its debt is a tax-deductible expense, so it actually lowers their total taxable income. This means the real cost of their debt is lower than the interest rate they're paying. The government is basically giving them a little discount for using debt.
Pretty neat, right?
Okay, so we've got the equity component and we've got the debt component. Now for the fun part. Let's put it all together and see how this thing actually works with a real-world example.
And there it is, the whole shebang. You can see the two halves of the equation right there. You've got the weighted cost of equity plus the weighted, and this is key, after-tax cost of debt. It's the complete picture.
All right, let's make this real with a quick example. Say we have XYZ brands. It's funded 80% by equity and 20% by debt. Its cost of equity is 10%, its cost of debt is 5%, and they pay a 25% tax rate. So, step 1, we get the weighted cost of equity. That's 80% times 10%, which is 8%. Step 2, the debt part. That's 20% times 5%, and then we apply that tax shield, which gives us 0.75%.
You add those two together, and boom, 8.75%. That is the magic number. That is the ultimate hurdle rate for XYZ brands. Any project they're considering has to promise a return higher than 8.75% to be worth doing. So we've got our number, 8.75%. It's super powerful. But, and this is a big but, a number like this doesn't live in a vacuum. To use it right, you have to understand the context and, just as important, the limitations.
Now, you might hear another term thrown around, required rate of return, or RRR. The way to think about it is this. RRR is the big general idea. It's the minimum return any investor wants from any investment. WACC is just a really smart, comprehensive way to calculate the RRR for an entire company because it blends what both the shareholders and the lenders require.
And here's a key takeaway. There's no such thing as a universally good WACC. It's all about context. Just look at this chart. A stable consumer staples company, selling toothpaste and soda, might have a WACC around 8%. But a riskier, high-growth tech company could have a WACC over 11%. Why? Because investors demand a higher return for taking on more risk.
And finally, let's be real about the limitations here. This isn't a perfect science. Remember, that cost of equity is just an educated guess. The math gets way trickier for companies with complicated debt structures. And of course, the real world changes, interest rates go up, tax laws change. That's why WACC should never be used in isolation. It's a powerful tool for sure, but it's just one tool in a much bigger financial toolbox.
So in the end, the best way to think about WACC is like a company's financial heartbeat. A low, steady rate, that suggests a healthy, stable business. A high or volatile rate could be a sign of risk. So the next time you're looking at a company, ask yourself, what's its WACC? And what story is that number really telling you?